Hello everyone, and welcome to this special Energy Scan webinar session dedicated to the war in Iran and its potential consequences for global energy markets. I'm Julien Waro, leading the economic research team here at the NG Global Business Unit, Supply and Energy Management. So since the launch of the Epic Fury operation by the US and Israel on February 28th, markets have been operating under a rapidly evolving geopolitical risk environment. And after more than 2 weeks of intense military activity in the Gulf region, a key question for energy markets is no longer whether there is a risk premium linked to this conflict, but how large and how persistent it could be. And at the heart of that question lies one critical issue, which is the risk of disruption to energy infrastructure and, of course, the Strait of Hormuz. So, to explore these questions today, I'm joined by the economic research team. So, Olivier Gasnier for macro and crude oil topics, Évariste Nuki for gas and LNG, Paul Chavy for CO2 emissions, and Luc Ruffier for European power. So, as usual, you can use the buttons on the bottom right of your screen to ask questions, interact with the speakers, or leave comments. We'll address your questions during the Q&A session. Only one Q&A session today at the end of this 1 hour webinar. The slides and the replay will be available on the EnergyScan platform by tomorrow at the latest, but you can already download the slides using the instructions displayed here. So click on the bottom right corner on apps, handouts, and then you should find the PDF document. So before we move into the market analysis, I would like to start with a very simple but critical question, and that's where we need your input for this one question poll. So the burning question, in your opinion, when will maritime traffic through the Strait of Hormuz resume? Is it by the end of March, the end of April, end of May, the end of June, or later than this, somewhere in H2 26? So what do we see so far? So thanks for those who took the time to answer. So if you look at first the end of March, which was I would say the initial expectations regarding this military operation. So we see only 50%. 15% of positive answers. We see close to 40% by the end of April, so 2 months closer of the Strait of Hormuz. But we see that if we have end of May, end of June, we are at 35% and even close to 50% beyond the end of May. So that's quite interesting and quite split in terms of answers. But I would like to put that into perspective. And we have compared your views to what predictive markets are signaling. So for those unfamiliar, we use Polymarket data. Polymarket, so it's a platform where participants effectively price the probability of future events, which make it a relatively useful indicator of market sentiment. And what Polymarket suggests is that investors are increasingly pricing a conflict lasting longer than initially expected, which is close to the pole we have this morning, with relatively low probability of a near-term ceasefire. We see only 14% by the end of March, which is quite close to the 15% we have in our poll and this morning. And we see that the odds are increasing close to 40% by the end of April, which is once again close to the result of our poll this morning. You can also see some specific bets and contracts related to the reopening of the Strait of Hormuz, and we see that the likelihood of a close reopening of the strait is quite low, with only 30% of probability on Polymarket for the end of April. So now let me present one last slide that summarizes how we frame the next few weeks for oil and gas markets through three scenarios, driven mainly by the duration and the intensity of the conflict and its impact on the energy infrastructure and the Strait of Hormuz. So our central case in the middle of the slide with a 65% probability is a conflict lasting 2 to 3 months. And in that scenario, we assume material damage to the energy infrastructure and, of course, a closure of the Strait of Hormuz between 1 to 3 months, which should lead to sustained production disruption for oil and gas in the Gulf area. And this would translate into Brent first nearby prices averaging between $90 to $100 per barrel between Q2 to Q4 26, so more or less the balance of year 26. And for natural gas, we see TTF monthly prices averaging 55 to 65 euros per megawatt hours in the next 3 quarters. This is an average, so we see upside risk in the near term for wholesale energy prices, followed by a gradual normalization later in the year. But this will be detailed by Olivier and Évariste just after that in the presentation. So a faster de-escalation remains possible on the left, but clearly less likely at 50% probability, according to us. So in that case, infrastructure damage remains limited. Hormuz reopens quickly, and upside price pressures fade rapidly. And finally, on the right, we have the tail risk, which we price around 20% probability, with a prolonged conflict extending beyond 3 months, with a severe infrastructure damage, long-lasting disruption to LNG and crude oil flows. This is the scenario where prices could overshoot materially, with consequences extending into 2027. So overall, markets are already pricing a relatively contained disruption with Brent prices around $100 per barrel, the TTF monthly contract around 50 euros per megawatt hour. But the key swing factor at this stage, of course, it's the duration and the persistence of supply disruptions. So these scenarios therefore define our risk framework. And the next step now is to assess how this geopolitical shock is translating into energy fundamentals. And so with that, I will hand over to Olivier to dive into crude oil market balances and the macroeconomic implications of this conflict. So Olivier, the floor is yours.
Yes, hello everyone. Okay. But I don't have the slides anymore in front of me. But it will be better. Yes. Okay. Okay. So let's start quickly because we have really no time this morning, and many things to say. So just a quick recap of how the oil prices began to rise, but actually that started during the two first months of the year, because if you remember, at the start of the year, the oil price was briefly below $60 per barrel. The market was focused on bearish fundamentals with a large oversupply expected for this year. And then there was the news about Venezuela, and then after that, the U.S. military forces going massively in the direction of Iran, and so it seems increasingly likely that something would happen. That, of course, occurred at the very end of February with the Israel attacks on Iran, the response of Iran, and then the U.S. forces joining the battle with Israel. At the beginning, we have seen oil prices going, say, to around $80-85 per barrel. That reflected really the feeling that the conflict would be short-lived, and that it would be over in a few days, just that it was the case in mid 25. But that wasn't the case, and Iran started to respond by attacking oil infrastructure in neighboring countries, and to block the Strait of Hormuz. As you can see on the graph on the right, the traffic has come to really to a standstill. Almost no ship going through the straits for more than 2 weeks. And that changed completely of course, the perception of the crisis by the market. We had a peak at nearly $120 per barrel, and then a fall, followed by a gradual rise, which is reflecting in a way the fact that the market is now moving to a position where it thinks that the conflict could last. And of course, probably we can assume that with prices around $105 per barrel, we are still in a situation where probably a majority of investors thinks that the conflict can end in 1 or 2 weeks, probably, without too much damage to the oil complex, and that the situation could normalize rather quickly. We envisage a scenario where, of course, that could last more than that, as Julien said already, and we could see prices continuing to climb to much higher levels. So just a word about of course, the Strait of Hormuz that is closed now. This is more than this is close to 20, or this was close to 20 million barrels going through this strait, and before the crisis. So that represents around 20% of the oil production or consumption, as you want. So this is absolutely very significant. And the International Energy Agency has described this crisis as the biggest in history in terms of volume that are impacted. As you can see on this slide, much of the oil that was going through the Strait of Hormuz was going to Asia, around 85 to 90%. So this graph is just about the Iranian export, but if you take the total amount of exports of Saudi Arabia, Kuwait, Iraq, etc., you have about the same kind of numbers. At the end of the day, you have between 85 to 90% going to Asia. So Asia is really impacted with, of course, in particular, some countries such as Japan South Korea being heavily impacted as they import almost all their energy from this region. China had accumulated massive stocks last year, and we understand why now, of course. So the other, as I said previously, the other way that Iran has made this crisis not only a crisis with Iran, but a regional crisis, a crisis that impacts all the Middle East. The fact that there are multiply attacks on the region's energy infrastructure. For the time being, if you look at the damages that have been made to these oil infrastructure, they are quite limited in a way. I mean, that could restart rather quickly, etc. But nevertheless, this is of course, that creates a general atmosphere which, of course, pushes risks higher on markets, etc. And for example, yesterday we had a respite on the fall in oil prices, and this morning prices rebounded because Iran attacked some gas fields in the United Arab Emirates. It's important to have those kind of numbers in sight. So why the International Energy Agency has qualified this crisis the biggest in history? Because right now you have around an impact of close to 10 million barrels in terms of volume of production for the countries of the Middle East, of the regions who are west of the Strait of Hormuz. That means that as the exports are blocked, and they have limited storage capacity, they have been forced to reduce or to stop some production sites, etc. So that is already a massive impact on the production of the region. So there are some solutions. The first one, if you look at the map on the right, is almost a solution just for Saudi Arabia, which is the pipeline between the west and the eastern part of the country, but it's limited to around 5 million barrels per day. And on top of that, there are limited capacity at the port that is in the Red Sea, the port of Yagu. So this is only a partial solution, but it's significant nevertheless for Saudi Arabia. But of course, for tankers that want to go to take oil there, they have to go through the strait, the Bab el-Mandeb point, which is of course under the threat of Houthis that are allies to the Iranian regime. So we haven't seen so far any action from the Houthis in the region, but they could restart what they have done previously, and they could attack some ships taking this passage to go to the port of Yagu, and to of course to carry oil on if they want to go to Asia. Of course, they have to take this road 2 times, which multiplies, of course, the risk to being attacked by Houthis. So far, it's not the case, but we can really seriously envisage that at some point, of course, the Houthi threats will resume, and they could also decide to attack the oil infrastructure and to attack, for example, the pipeline. That is a possibility that has occurred already in the past. So it's only a partial solution, and it's also a fragile solution. The other solution is what has done the International Energy Agency, is to coordinate a release of strategic reserves. So the countries have decided to release 400 million barrels. But here again, and it explains why it had no impact on the market, no impact on oil prices. It's only a temporary solution if the Strait of Hormuz remains blocked. Even if you assume that the release of reserves will be 5 million barrel per day, for example, and that won't last forever. I mean, it can only be something that just limits the lack of supply on the market for some time. But again, it's absolutely necessary to unblock the Strait of Hormuz to have a durable solution. Another thing that is probably important to have in mind is the fact that the US is not that much in a strong position. I mean, on the military side, it's absolutely obvious that with Israel, they have won the fight, that they have destroyed many military sites in Iran, etc. But if you look at the situation for the Trump administration in terms of disposal of strategic reserves, it's absolutely limited. So the US will of course participate to a release of the reserves, and they will release 172 million barrels. But look at the graph on the right. At the end of this operation, the level of strategic reserves in the US, the strategic reserves that had been depleted massively under the Biden administration, the level after that will be below the level after the second oil shock at the start of the 80s. So extremely low. So the room for maneuver is rather limited. And after this release, probably it is non-existent for the US. Second thing, there are midterm elections at the end of the year. And already we can see that retail gasoline prices are sharply up. They are now close to $4 per gallon. There is also a sharp rise in diesel prices. And so, of course, it's extremely negative for Trump and for the political support in the US. So he cannot let the situation, of course, lasting forever. So in terms of global supply-demand balance on the oil market, if you remember, until before the crisis, we had a situation that explained why the oil prices were so low, below $60 per barrel at the start of the year. We had a situation of massive oversupply that we estimated between 2.5 and 3 million barrels per day. The International Energy Agency had even a more pessimistic forecast with an oversupply around 4 million barrels per day. Now, I think the situation will completely change. Probably the equilibrium, there will be a rebalancing of the market for Q1 with the loss of production we have seen since the start of the months in the region. And probably in Q2, even if you take into account a scenario where the situation normalized during Q2, end of April or during May or something like that, with a slow restart probably in production, not at the previous level for technical reasons, etc. There will be a massive deficit in the market, probably between 6 and 7 million barrels per day. And you can, even in a rather soft scenario, you can envisage probably a rebalancing of the market, probably in the course of Q3. So all in all, the market would be in deficit by around 1.5 million barrels per day. So a total change of situation. And in terms of perspectives for prices, we can see on this graph. So we have the two dotted line that are very low. Those are the previous forecasts before the crisis. The dotted line in gray that is quite low as well implies nearly an end of the conflict that is almost immediate. And so we could see prices going down rather quickly, but we don't believe in this scenario, because even if, for example, Trump declares victory and wants to stop the war, we can imagine that Iran won't stop blocking the Strait of Hormuz immediately. So we have a central scenario that envisages that prices could continue to increase, and we have retained an average of $120 per barrel during April. So this, we can envisage that prices could go higher, but there is an end to the crisis during Q2, and then you have a comeback to a more normal level. Note that we are quite close to the oil forward curve in the market right now. So even if we are much higher at the start, after that the shape of the curve is rather similar. And of course, we have an extreme scenario that Julien has presented already, where the crisis lasts, and you can imagine that prices go to 150 or probably much higher with severe economic consequences. So I will accelerate because I'm late already, I know. Just in terms of economic consequences, I won't detail the scenario. I mean, I think you will have the slides, and it will be quite easy for you to look at those numbers. And if you have questions, you can reach me after that without any problem. Just some ideas. So first, the mechanism is rather simple. If you have higher energy prices, you have lower purchasing power for consumers, lower corporate margins, of course, which has consequences on investment, employment, negative consequences. And there is a kind of a negative loop because, of course, that impact after that negatively consumer spending, etc. in consumers' country. Second idea, advanced economies have become nevertheless much less sensitive to energy prices than it was the case during the 70s, for example, due to the economies that have been implemented, innovations, the strong development of renewable energies, etc. So there is a factor of 3 between the impact in terms of energy intensity between the 70s and now. But of course, in many emerging countries, of course, there are still a strong exposure to a sharp rise in fossil fuel prices. One important difference is as well in the other way this time is this time the crisis is regional. With the blockade of Strait of Hormuz, it has impact on other countries, not only Iran. So there is a permanent heavy loss of production, and of course, the longer this situation lasts, of course, the more severe the impact will be on global growth. Something that has to be taken into account as well is the fact that the economic importance of the countries in the region of the Gulf monarchies has increased considerably since the 70s or 80s in terms of air traffic. These are very important countries with a large hub in those countries in terms of tourism activity. And for this region, of course, this crisis will have lasting damages that will be probably massive in the future. Something that we have to take into account, the fact that the global economy has suffered several crises, the inflationary shock already, and so after the COVID, the impact of the Ukrainian crisis, and also the US trade policy last year. So in a way, this oil shock comes after several shocks and it hits fragile economies. In terms of inflationary pressures for some countries, notably in the US, they have not completely disappeared. So another shock coming after a shock that has not been completely solved. In terms of means to address this crisis, we have to keep in mind that there is almost no room for maneuver in terms of public finances for many countries. I mean, if you look at the state of public finances in the US, in Europe, etc., it's clear that we have a very limited room for maneuver. And last thing, the potential impact on financial markets, the fact that there are rising interest rates due to the expectations of higher inflation, and that could exacerbate some cracks that we have already seen appearing, in particular on the credit market, and this is quite a bit worrying. So, well, as I said, I won't detail all those tables, but of course, we have taken into account the inflationary shock that could represent for consumers' countries. So, while disinflation was expected everywhere, now we can envisage seriously that inflation will be above 3% at least in almost every country except in China, where there are some deflationary forces. In terms of impact on growth, I think it can, even if we take a middle scenario, I would say it can remain manageable. Below 3% of global growth, there is a kind of state of crisis. I mean, you have to take that into account. This is important. So 2.9, 2.8, 2.8 for the forecast we have now for global growth. It's low, but it's not the negative number that we have seen, for example, after the global financial crisis at the end of the year 2000. There were some fiscal plan already implemented in Germany, in the US and Japan. There is a fiscal support that is coming. Despite the high level of indebtedness, there are some way to absorb the shock, as for China that has accumulated a large amount of reserves, it's kind of thing. So I'm not that pessimistic, but nevertheless, of course, there will be a negative impact on global growth. That is absolutely obvious. On financial market, just to illustrate, and I will have finished after that. The fact that expectations for interest rates have completely changed due to rising inflationary expectations, and the fact that, of course, the expectations about monetary policy have changed. For example, now there is a rate hike that is expected for the ECB, and only one rate cut expected for the Fed at the very end of 26. So now, when you look at the forward curve on the on rates, it's the US is really an anomaly. All the countries are on the upside. For example, the Reserve Bank of Australia today has increased its key rates. In terms of reaction of the world equity markets, if we focus on the US or even a bit in Europe, you can say that they are a bit disconnected with this situation and the reaction is very limited. But if you take a wider index, taking into account especially Asia, where the reaction has been more negative, on any emerging countries which had benefited from a very positive environment and now are much more exposed, you can see that the reaction has been significant to the rise in oil prices nevertheless. And so the impact is also significant. One of the beneficiaries of the crisis is clearly the dollar that have stopped falling and has rebounded. Can we say really that the dollar is back to the safe haven currency status that it had a bit lost with the Trump policy last year? Well, when you look at the evolution, it's difficult to say that the dollar has rebounded, but it remains quite limited. The real safe haven currency for the time being is the Swiss franc. Swiss franc is extremely strong. So you can see that the euro has weakened a bit, etc. The yen also is weak. The dollar has rebounded, but it remains limited. And in my view, it's only temporary because you have many hurdles to come, and in particular the elections, the midterm elections, which are very uncertain at the end of this year. So just to conclude, I won't detail that. We have, of course, proposed alternative scenarios, a soft one, a hard one, with of course, lower growth if that was an extended conflict. But here again, I won't repeat. You can have some time to look at the numbers. Tell me if you don't agree, and or ask question if you want. No problem with that. I'm done, Julien. I'm sorry to have been a bit
Yes,
long.
yes, thank you, Olivier. I think, yeah, we can move on to the gas part right now with Evariste. And don't hesitate to ask questions in the chat. We'll do a Q&A at the end of the session.
Thank you, Julien. Hello, everybody. So on the gas side, let's start with some numbers. I guess you are well aware of them. They are put on the comments on the right. The importance of Qatar, number 2 LNG exporter. The importance of the Strait of Hormuz, because the bulk of Qatari volumes transit through the strait. But just to put those numbers in perspective, let's comment the last numbers. In fact, LNG supply, if you take it globally, it represents, we can say, only 14% of total gas consumption, because bulk of gas consumption is coming from domestic production, of course, but also from pipelines. This is totally different with the numbers we have for oil. Just to say that this crisis is above all and first an oil crisis. And last number, if you take Qatari volumes, they represent slightly below 3% of total gas consumption. So yes, Qatari volumes are important, but they don't give all the story. And to probably to have more details on that, we can refer to the table on the left. So as I say, Qatar is number 2 LNG exporter behind the United States. And then the last column of the table gives you the trend in LNG flow since the start of the year. So bulk of additional supply is coming from the US. So the key question now for all LNG exporter will be to know how they could perform above the numbers we are currently seeing, so as to offset the decline in Qatari volumes. We'll come back to it later on. So this is on supply, and on the demand side, you have the same. Yes, as I say, Qatari volumes are going mainly to Asia, but if you look at this last column, you see that Europe is currently the zone that needs more LNG. So on one side, you have Qatar, Asian buyers will have to compensate Qatari volumes. At a time, Europe will also seek additional volumes to offset the decline in Russian flows. So this will be important, but the supply also will be important. Now, if you move to the price reaction, of course, when prices increase, the first step was to challenge what we call the coal switching level, the level at which you can switch between the gas plants and coal plants. You see that resistance level was broken quite easily. It is obvious. In Europe, you don't have enough coal plants now because of the decision to phase out the coal. So this resistance was broken. But the next one is probably the most important one. It was the Brent level. For a while, when you look at the trend in prices, gas prices, both TTF and GKM, they was trading below Brent prices. At the time, you were saying that yes, this was normal because in Asia, you have a lot of buyers that still have long-term contracts. So they will not accept to pay above the Brent price, above their long-term contracts, because if they don't have enough gas on the spot, they can appeal their long-term volumes. So the Brent resistance is relevant in a normal situation, I can say. Normal situation meaning that you are not so tight, and by referring to your long-term volumes, you have enough volume to supply all your needs. But of course, you can imagine that when there is a tightness on the market, with the loss of long-term volumes, because Qatari volumes are mainly long-term volumes, this resistance is no longer relevant. That's why the Brent resistance was broken, and the next resistance is clearly the gas oil price. On gas oil, you are clearly at the maximum level. You can see it when you look at the graph on the left-hand part of the graph. In 2022, gas prices, they challenged the gas oil level. But this time, you see that they didn't manage to break that level. Again, this is an indication that clearly the crisis is an oil crisis. That's oil prices that are very high, and that's the high level of oil prices that is opening upside potential to gas prices. So I mentioned the supply side in the first table. Here you have a graph coming from S&P Global, an interesting one that shows that on the LNG side, we tend to look at just the final numbers in terms of LNG production, but as a physical asset, an LNG liquefaction plant has a utilization rate. So what they did here is to compare the utilization rates of all the plants existing currently. And they conclude that last year, we were below the level we reached in 2024, meaning that there is room to increase the utilization rates of LNG plants, to improve the efficiency. Of course, this will not happen in all the plants. Here you have the explanation for the low utilization rate. On some plants, you can have some feed gas problems. On some other plants, the plants are aging, so meaning that more and more they are facing some technical outages. But we do believe that there is still room to increase efficiency in some LNG plants so as to increase total LNG supply. So this is for supply, and then the other solutions are clearly on the demand side. Qatari volumes, they are going mainly to China and India. What we did here is to look at the supply demand balance for the two countries, and to look at also what happened in 2022. This is done on the last column, comparing the values of 2022 compared to 2021. Let's start with China first. What the table shows is that in 2022, China managed to cut significantly its LNG imports, mainly by increasing domestic supply and also pipeline imports. We believe that this year, those two solutions can still be in place to limit LNG imports from China. And then when you look at the continuation of the table, you see that for domestic production, for instance, China continues to increase domestic production. Pipeline imports, the same. You know that they are importing a lot from Russia now via the Power of Siberia pipeline. They are also importing for Turkmenistan, Uzbekistan. So they have options on the supply side. They also have some options on the demand side. On power, probably not many options, but on the transport sector, we believe that you could have a limitation in transport demand. In this transport demand, bulk of demand is for LNG trucks. And we know that they are now facing competition from electric trucks. And yes, given that gas oil prices are also increasing, competition will not be on the gas oil side. But clearly, this is also an incentive to continue to push for electric trucks and to continue to limit the development of LNG trucks. As for India, probably the country has less room for maneuver compared to China. First, they don't have a strong domestic production. They don't have pipeline imports, meaning that they rely more on LNG imports. So for them, the first option is clearly to reduce gas-fired generation. And you see that this was what was happening in 2022. And we believe that this year, this time, they could also reduce the utilization rate of gas-fired power plants so as to increase that of coal plants. So this is for China, India, and you can even do the same for other Asian countries as a whole. We believe that for those countries, the main option will be to switch to coal. And to illustrate this, we just put this graph. So for Japan, for instance, we compare power prices in Tokyo as a benchmark, compare them to the range of clean gas costs, just taking the GKM price. And what you can see here, when you are on the lower part, when power prices are on the lower part of the range, it means that the market is not so tight. So you are cooling the gas plants that has the highest efficiency. And when you are tight, of course, you are on the higher part of the range. With the sharp rise in prices, of course, all the plants are paying a high price. But you see, nevertheless, that power prices seem to be on the lower part of the range, meaning that you are minimizing the coal to gas plants. You are coaling the gas plants that are the most efficient and reducing those that are less efficient. We didn't have enough data to do the same for coal when you look at Indian prices, but you see that it is exactly what is also happening on the coal side, with power prices far above the average coal cost, meaning that we are closer to the upper part of the coal range. So you do the opposite on the coal side. You are coaling the coal plants that are more efficient, of course, because the coal market is not tight. So you are maximizing the utilization rate of coal plants by coaling all the plants you can and reducing those of gas plants. Overall, I believe that this is clearly what will happen in Asia. The main option will be to increase the coal to coal plants when you can, because yes, you can imagine that in some countries you can have some network constraints, so you cannot totally move the coal, the coal-fired production to the consuming region. Yes, you can have some network constraint, but overall, we believe that some substitutions clearly will occur on the coal side. So at the end, both for Asia and Europe, despite all those substitutions, we will not be able to destroy totally the lost volumes, meaning that you will have some competition between Europe and Asia to attract LNG volumes. And here you see that European LNG imports, they are still very high, but of course, clearly we expect them to gradually drop because Europe will have to lose some volumes in favor of Asia. Coming back again to the price direction, let's start with the one on the right. Again, to illustrate clearly that this is an oil crisis, at least for now. Here we compare day by day the Brent price, gas oil price to gas prices. And you see that first, when prices reach the Brent price, they challenge the gas oil level, as was the case at the start of 2025. Just look at the graph, the graph on that period. At that time, there was no oil crisis. When you don't have an oil crisis and the crisis is only on gas, yes, the gas oil price can set a maximum. But this time, you see that prices, I guess they challenge first the gas oil to see, yes, can we stop to the gas oil level? And then with the gas oil level increasing, this open the door for an increase in TTF and GKM prices. Another point we can mention here is the behavior of investment funds. You can see this on the graph on the left. You see that they are now significantly net long. With the last numbers we have, they even increase their net long positions. And you can imagine that with the current situation, some of them, let us say the majority of them, could decide to keep their position, their long position, and even increase them. Increase them means that gradually they believe that the war could be longer than expected. So this is the story we are now telling, and you see that the market reaction is backing that story. When you look at the TTF calendar 27, the last the graph on the bottom left, you see that prices they broke the resistance of the 1 year average, and now clearly they are far above their levels of the previous days. Gradually, we are seeing that there is a reduction in the spread between the month side and the far curve prices, meaning that gradually the market is pricing a tightness that could last above just a month or 2 months horizon. This leads us to our scenarios. So just to remind the levels of the stock at the start of the year, to remind as well the levels of LNG sendouts and local gas demand for last year, because these are our starting point. And then we make some assumptions for the other components, Norwegian supply, Russian supply. And for Russia, you have to be careful as well, because you are starting to have some attacks on Russian infrastructure. So Europe is still receiving some Russian gas. So you have those flows will continue to reach the market. You have assumption of domestic production and export to Ukraine, for instance. And now you can make assumptions on the two main drivers, demand and LNG sendouts. So for demand, we reduce a little our forecast, because we assume that with such high price levels, we'll start to see some demand destruction. I mentioned already the fact that in Europe, gas prices have moved above the coal switching level, meaning that we will lose some gas demand in favor of coal. So this will end with lower gas demand. But of course, the key assumptions are on the LNG side. And here, the three scenarios Julien mentioned, you can put them here and see how they combine with demand to give the actual stocks at the end of the year. So in scenario three, you have a war that is lasting just for some weeks. At that time, we believe that we will already see some demand destructions. It means that this is a very favorable situation where, of course, the disruption on LNG supply is not so significant, and you are seeing demand destruction. Of course, you'll have very high stock levels at the end of the year. Scenario two, the war lasts 2-3 months, and you don't have the ability to reduce a lot your demand, meaning that stocks will be above those of last year, but below the stocks of the previous years. And the worst scenario, obviously, is scenario one. The war lasts longer than expected. And at the same time, you don't have the ability to reduce demand, just because you can have, for instance, during the summer, lower renewable, or you can have a cold winter. In this scenario where you have low LNG sendouts, low LNG supply, and high demand, of course, the European gas balance will be very, very tight, with a strong impact on prices. So this is summarized on this graph. when you look at this, you see that yes, compared to market prices, we believe that there is still upside potential. So we believe that prices can still continue to increase. But you see as well that gradually we expect that the high will be less and less important. The magnitudes of the increase should decrease. Why? Just because we believe that demand destruction and all the supply adjustment, I mentioned the increase you can have by increasing the efficiency of liquefaction plants, by postponing some maintenance as well. So all those measures should normally reduce the magnitude of the price increase in the coming months. So that's all for gas, Julien.
Thank you, Évariste. So we are clearly late on schedule, so we'll try to conclude as quickly as possible. But if you have some time after 11 a.m., stay with us because we have some elements to share regarding emissions, power, and also take some time for questions. So, Paul, I'll let you go on with the carbon part.
Yes, thanks, Julien. And hello, everyone. So yes, so on EUAs, they've stayed quite muted and even have a negative correlation with gas and oil prices in the recent days. So let's see why. So 3 scenarios also on how the conflict could impact EUA prices depending on how long it lasts. So the first one here is under a 4-5 week scenario. So here, as you can see, the green dashed line, which shows a short-term dip before prices recover broadly in line with our initial forecast. And the reason is, if you look at the chart on the right, and it was already mentioned by Évariste, if you look at coal and lignite-fired power generation in Europe, there is actually very low additional coal and lignite-fired power generation because the energy mix has changed materially since 2022. Renewables now cover a much larger share of generation. So the system reliance on coal as a backup fuel is strictly lower. And on top of that, we're heading into spring, which is a low heating demand month. So there is almost no coal to gas switching, and need for coal-fired generation is simply subdued. So there is no imminent surge in emission to justify a carbon rally. And so without that fundamental anchor, the risk-off sentiment takes over for EUAs, as equities are doing a bit, and EUAs would drift lower, but would recover quite quickly. On a second scenario, here, so the orange dashed lines, you can see, shows much deeper and more prolonged dip, with prices falling to the low 60s before recovering if oil and gas prices were to stay very high for a couple of months. And it is mainly because the European Commission could release measures to lower carbon costs on high energy prices. Because if you look at the right chart, this timeline explains why in 2026 it's already an extremely EV policy calendar for the EU ETS, with in July the free allocation phase out review, and after the MSR and ETS review. So that is a significant amount of structural uncertainty packed into a very short window. And there's already been a lot of pressure from industry to lower the cost of carbon prices, mainly due to the free allocation phase out. And right now, higher energy prices could give actually the green light to the European Commission to soften carbon costs by adding supply. So either by softening free allocation phase out, or by releasing volumes through the MSR. And with the EU Council this week, this could be news very shortly. So this would have an impact both in the short term and to longer term, as it would increase the supply-demand balance. And on the last scenario, which is here the red line, and tells a very different story. So in the case of higher for longer oil and gas prices, it could in fact trigger a recession in Europe. So prices could collapse near 50 euros per ton, and the recovery would be very slow and shallow. And I wanted to show you this chart on the right, and it's key to understanding because it shows the euro area industrial production growth alongside ECB interest rates from 2022 to 2024, so after the crisis. And the parallel with today is important because back in 2022, the energy prices surged, inflation came back with force, and the ECB responded by aggressively hiking rates. And what happened to industrial production, as you can see, it collapsed, and you can see it clearly on the chart where when the industrial production line turns sharply negative as rates rise. So first, higher energy costs could deeply damage the industry. But it wasn't just energy costs that damaged the industry, it was the combination of high energy prices and higher interest rates also that crushed the industrial output. And in a prolonged conflict scenario, today the same dynamic could unfold if persistently high energy costs reignite inflation fears. Rates could rise again, and that compounds the same damage to industry well beyond what energy costs alone would cause. And on top of that, so the policy response would almost certainly include a significant expansion of free allowances to shield industry and adding supply directly to the market. And more structurally, in the long term, if industrial activity is durably impaired, you get a lasting decline in emission, not just for one compliance years, but for several years. And this would change evaluation and shift us from a short-term correction to rewriting of the long-term price trajectory. Voilà for me. Julien, I'll let the floor to you.
Thank you, Paul. Thank you for those insights. Let's move to power quickly. So first thing we could have in mind is that this crisis so far is an oil crisis and has impacts on the gas side. But unlike the crisis we experienced in 2021 and 2022, it's not a power crisis, not yet at least. Why is that? Because the power system is much stronger. We have good nuclear availability, hydro stocks and hydro generation are high. We are not yet forecasting a really strong drought event, unlike 2022. So the power system is much looser on that end, and the impact is in a way much milder. So there is no cumulative effects on that side. So because it's a gas crisis, of course, it's going to impact gas generation in Europe. But you can see that overall, the system has benefited from a strong build-out of renewables. The generation from fossil fuels, coal and gas here on the right chart, is decreasing strongly. So we have this decreasing effect years after years of the power generation, the gas power generation on the power prices. Oh, it was already mentioned by Évariste and Paul, but when you have higher gas prices, what you can do is use cheaper plants, and those cheaper plants could be coal plants, but the availability of coal plants still open in Europe has decreased sharply. So compared to 2022, if we take all closures into account, we have about minus 56% of coal plants opened in Western Europe. So that's significant, and the potential for fuel switching is therefore much milder. One thing to have in mind, though, is that there are quite a lot of plants in reserve in Germany, about 6 gigawatts of coal and other type of plants in the reserve. If it was a lasting crisis, we could see politics pushing for putting those plants back on the market, therefore easing the price effect on power prices. That was the case in 2022, where we saw several gigawatts of power plants being brought back to market. Then second point, on the thermal generation side, you can see on the left chart that if you look at the profile, so the x-axis is hours, so you have more thermal generation during night or morning peaks and evening peaks, rather than during the day. So it's a yearly average, of course, changes from winter to summer, but you have this the concentration of thermal output on those morning peaks and evening peaks, which are likely to still be tight, and we are likely to see strong volatility from that. But overall, we'll need less and less thermal generation. And lastly, how have prices reacted to the developments since the start of the crisis? You can see that on the left chart for Cal 27. So they are a bit less important than what we could see on the front of the curve with month-side prices. But overall, the trend remains the same. You have a strong increase for power prices, especially countries which have a high marginality of gas and coal in their power mix. So that's the case for Germany, for instance, and its close neighbors, so Netherlands, Belgium, and that's represented in the chart in the middle. So how often fossil fuel plants set power prices. So that's what we call marginality. While at the bottom, you have France and Spain, which are much more discounted because they have a higher share of hydro, renewable, and nuclear mix, which shield them in a way from those price effects. And they're actually not that strongly impacted so far. And from a scenario point of view, taking into account what Évariste and Paul mentioned, so you have this offsetting of effect of EUAs with offsetting partially the rise in gas prices. We still forecast an increase, that's right, but a moderate one. Our base case being 2-3 months, we expect about 20 euros per megawatt hour to be the price increase for Germany. We take Germany as a benchmark for those figures of increases. Of course, it's going to be much less for France and Spain, for instance, but that's the order of magnitude. And of course, if we move towards a longer, lasting crisis, we are likely to see prices rising by plus 30 euros per megawatt hour. You need to take into account that it's compared to the 27th of February, so we are already closer to those figures, actually. I think, Julien, we can move to the Q&A section now.
Okay, thank you, Luc. Thank you, Paul, for speeding up a bit the presentation. So we have some questions, and we will take some time to answer. So thanks to those of you who stayed with us a bit beyond schedule. We apologize for that. So first, I'm just going to launch the satisfaction poll at the same time and ask a question to you, Olivier. Regarding oil demand, we talked a lot about the oil supply shock, but what about demand? There is a question regarding your supply demand table with a relatively stable demand. What is your view on that? Shouldn't oil demand drop in face of a strong increase in prices?
Yeah, so well spotted for the question, because I must admit there is a problem in this forecast. I mean, the oil demand has been adjusted for the OECD countries. I don't see any problem with that. But for non-OECD countries, clearly the Q2 and Q3 demand should be lowered. I mean, we have already many examples, especially in Asian countries, of government taking measures to reduce their demand, etc. Of course, on top of that, there will be consequences on companies as well. So yes, clearly the non-OECD demand forecast should be lowered. That being said, I guess that at the end of the day, there will still be a massive undersupply in Q2. That won't be that large, and probably the consequence would be a total rebalancing of the market in Q3. And so all in all, I would say that if we want to correct the evolution of stocks on the year, and instead of having a deficit of around 1.4, 1.5 million barrel per day, that would be probably closer to 1 million barrel per day. So that doesn't change fundamentally the shape of the evolution of demand and the imbalance between demand and supply due to the reduction in supply. But nevertheless, well spotted, and I apologize for that. There is clearly a downward adjustment to be made on non-ACD demand. Yes.
All right. Thank you, Olivier. One question for Évariste on the gas, European gas supply. So I don't know, Évariste, if you are still.
Yes.
Yeah, you are there. There is a question regarding the risk for gas. So do you see the gas risk in 26 as primarily a price problem, or could it become a physical availability problem for industrial customers?
It is a physical problem for those who receive Qatari volumes, of course. So I guess that those I mentioned that Europe is not taking a lot of Qatari volumes, only around 8%, meaning that if you are not receiving Qatari volumes, no, you are in face of your supplier. It can be a Norwegian producer, or so normally you don't have a physical problem when you are not buying Qatari volumes. You have a price problem because all prices are increasing, but you don't have a physical problem. And we expect that, yes, the problem will be mainly for those that are buying Qatari volumes.
All right. Clear. Thank you for that. One question for Paul regarding the EUA market. So, Paul, do you think a potential market intervention agreed by the European Commission, and what is the likelihood to see that? So, can a potential intervention change your carbon price forecast given the higher reliance on coal for power burning? This should be to do the thing to offset the high gas price impact.
Yes, indeed. Yes. There is two things actually that will be discussed as soon as this week by the European Commission, which is the free allocations that will much more have an impact on after 2030 supply demand balance. So in that case, it wouldn't change that much the forecast. However, if we see an intervention with higher MSR intake, which means that lower reduction volume by the MSR in the end of the year or during next year, that could be easily done by the European Commission. And in that case, yes, this will deeply impact carbon price forecast for the months and years to come. Yes.
All right. Thank you, Paul. So I think it's time to close the session. So thanks to those of you who took the time to answer our satisfaction survey. So I hope you enjoy this session. Remember that you can find the replays and the replay in the slides in the Enerscan platform in the coming hours or tomorrow at the latest. So see you soon on Enerscan, and goodbye.